The GEO Group is the largest position of Michael Burry according to the latest 13F filing by his hedge fund. And currently, two other super investors also have position in this prison management company. In this video, we will explore some pros and cons to see why super investors are buying this stock, and finish with a quick valuation of the company. The GEO Group was originally founded in 1984 with a different name, but in 2013, based on its stable business model, it became a REIT, which boosted its stock price. And using its highly valued stock, GEO acquired its competitors to get very large. However, in 2021, GEO gave up its REIT status and now is a normal corporation again. This lowered its stock price to 15-year low, and such beaten down price created a great buying opportunity. This company has three main operations in the US. The first is Secure Service, which owns and manages prisons and also provides transportation to and from these facilities. The second is Reentry Service, which provides education and facilities and help people adjust to society quickly when they are released. The third segment provides electronic monitoring of 260,000 individuals across all 50 states. And now, if we look at the revenue breakdown, the first, Secure Service, contributes about 2/3 of the revenue, while Reentry and electronic monitoring segments contributing about 12% each. And the rest, 10%, comes from international facilities. The secure facilities market in the US are quite consolidated, with GEO and CoreCivic, the first and second largest players, holding about 80% market share. FYI, Michael Burry also invested in the second player, which shows how aggressive he is about the industry. This industry in general are considered a high moat business because they have more than 75 years of very long useful life, and also because the nature of the facilities, most neighborhoods avoid new facility, which means it's hard to get new licenses. In addition, the main customers of these facilities are government agencies, and so the customer credit quality is quite high. And it's important to note that about 50% is from the three federal government agencies, and we will discuss the ramification of this later in the video. This combination of factors makes GEO a very stable business overall. But the company is not without risks. First of all, there was COVID-19 issue. ICE, the largest GEO customer that contributes about 25% of revenue, largely uses the facilities to lock in illegal immigrants, mostly from the southern border of the United States. However, in 2020, when coronavirus risk was high, the government used Title 42, which kicked out illegal immigrants immediately to stop spread of the virus. And since the occupancy rate at its facilities are important revenue for GEO, the starting of Title 42 in mid-2020 lowered the occupancy rate from 90s to mid-80s. But more recently, two important changes took place. First, as corona risk is going down, more people are flooding the southern border again, as this graph shows. In fact, more people are reaching the border in the past 2 years compared to 2019 before COVID. In addition, as US court ruled that Title 42 is not legal, the negative impact from this first challenge is expected to go away. However, another risk surfaced with Biden administration in early 2021, which is that President Biden signed an executive order which forbid these federal agencies from renewing their contracts with privately owned criminal detention facilities, many of which are run by GEO. As a result of such change in government attitude, GEO is getting hit by lower contract renewal from the federal government side. Although this executive order only relates to these two federal agencies, but not ICE, and although GEO can respond by changing the form of its detention facilities, such operating risk forced GEO to give up its REIT status, and also triggered even lower stock price. Now let's move on to the financial analysis. As you can see in the blue bar here, GEO's revenue began to fall since 2020, but interestingly, its operating income, shown in orange, actually increased. This is thanks to the new CEO, who took charge in mid-2021 and is focused on cutting costs in the face of aforementioned operating headwinds. CoreCivic, the second player that Michael Burry also invested in, had lower revenue as well, but this company's operating income decreased along with the revenue. As these two companies gave up REIT status in 2021, they both cut dividend down to zero now. Now they're retaining instead of paying out dividend, But as we can see here, the operating cash flow shown in the blue bar continued to come in. So what did GEO do with this cash flow? The answer is shown in the gray bar, which shows significant cash uses for financing. So basically, GEO spent the money to pay down the debt, which had large impact in 2022. And thanks to such effort, debt to EBITDA ratio of GEO, shown as the blue bar, fell from 7 to 8 times to near 4 times. CoreCivic also focused on the debt reduction, and so its leverage ratio is also below 4 times. The reason why GEO focused on debt reduction so much, even by giving up risk status, was because when the negative operating risk broke out, and the debt level so high thanks to the large M&As to get larger in the past, GEO's credit rating deteriorated to CCC+, and 6 banks even announced to stop lending to the firm. As a result, GEO rearranged its debt structure, and the result is shown here. The green bar, which shows the original debt maturity, is now pushed back to the blue bar, further into the future and more spread out. And so GEO is now free from debt burden until 2026. And GEO's credit ratings slightly improved to B and B3, but it's still at a junk bond category. And investors should be aware that 55% of GEO's debt are floating rate, which means if Fed keeps increasing rates, GEO's interest expense will also increase significantly. So far, it looks like GEO has meaningful pros and cons. So in the end, it will come down to the intrinsic value of the company to make a sound investment decision. And for this, I use GEO's normalized free cash flow numbers, basically using the pre-COVID numbers and increase it by 1% per year. This is somewhat simplified and optimistic, but not too aggressive. And as a result, the model showed 14.3% annualized return over the next 10 years. In general, anything above 10% means reasonable valuation because over the long term, the stock market in general also creates about 10% return. However, if I look at some real risks that GEO still faces before generating the fully normalized free cash flow, I feel like the expected return should be much higher, at least 20% or more. If that's the case, why is Michael Burry investing so aggressively in not only GEO but also its competitor CoreCivic? The answer lies in this stock chart. Based on public filing, Burry traded in and out of GEO since late 2020 and bought the stock nearly $6 to $7 per share range. So if I run the model using $7 per share purchase price, the long-term expected return turns out to be 28.4%, which seems to compensate for the potential risks that we discussed before. So basically, Burry bought the stock when it was much cheaper, and he could expect more than 25% annualized return at those lower prices. But since the stock price went up already by more than 70% from Burry's purchase price, even if the stock is still somewhat underpriced, there is less margin of safety and more risk now. For those of you who like to make numbers-based investment decisions, this is a scenario analysis of the annualized return, depending on the price we pay for the GEO stock. For example, if you like to make more than 20% from GEO investment, then you can decide to buy if the price falls to low $8 per share. But if the stock price continues to climb from the current level up to the historical average, then it would not make sense to invest in GEO. Alright, that's gonna do it for today's video, and thank you all for watching. I really appreciate it. If this video benefited you in any way, please click the like button below and also subscribe to the channel. And I will deliver deep dive numerical analysis on companies that are chosen by super investors. Also, feel free to share your thoughts on GEO. Why are you buying it or avoiding it? Please share in the comments. Okay, thanks again, and I'll see you in the next company analysis. Take care.